Okay. Real quickly, I want to go through just a real quick presentation of what I think is happening, and we're going to deep dive on a company called Soul Gold, because I want to give you all a sense of how we evaluate things, and then we're going to do some questions and answers after that. So I'm going to do this fairly quickly. Joe Mazumdar, who is my partner in this business and has been doing more and more of the writing of the letter, is up here, and we'll be taking questions at the end of this. So let's get this out of the way. You there? All right. So I've used this slide for years now, so I'm not going to go into a lot of detail. Basically, what that says is we are not finding enough new deposits to replace what's being mined. And this has been going on since about 2006. That is destined to continue happening, and I think that opens up a real opportunity for all of us in the junior exploration sector. And I think it's going to get better and better as the majors realize they need to start moving down the food chain to get their acquisitions. And here's the list of more recent gold resources, 12 to 16. Again, you can see we're producing about 90 million ounces a year, and we're finding only in the order of 15 to 30 million ounces a year. And this is what the major production profile looks like for Newmont and Barrick. And what you can see is, as out over the future, they do not have the reserves to replace what they're mining. And bear in mind, it takes 10 to 15 years to put a large mine in production or more. So they're in trouble. And the fact is, discoveries are getting deeper, and this is where we're going to go from here. And this is a chart that shows where discoveries have been made at what depth since about 1900 to 2000 and probably 10 or 15. And it's clear you can see the discoveries are going deeper. That has a lot of implications as to how you explore, how much it costs to explore, how much it costs to prove up a resource, feasibility study, etc. So let's look at two types of mines. We're looking at a porphyry copper deposit, open pit versus block cave underground. The open pit, what you can see is, let's assume that a company needs an IRR of 15%. To make that 15% on a block cave underground operation of a porphyry copper, you need a deposit that is 2.2 times more or less greater than the equivalent you could do in an open pit. So we need a much higher grade deposit to finding these deeper ones to produce the IRR they want. And the example I give here is a 1.5 gram gold deposit equates to a 3.3 gram per ton block cave. Same thing for copper. 0.7% copper open pit, you need, ballpark, there's a lot of variables here, about 1.54% copper just to break even. And here's some more specific numbers on this. What we've got here is a block cave operation versus an open pit. Development time is much more for a block cave, a ramp-up time, and you can see the mine development and operating Capex. And what I've done there in the outline there in the red is the ore value required to achieve the IRR. With a block cave, you need $82 a ton rock versus an open pit, which is $37 a ton. So let's look at a recent discovery. And I'm going to talk about this, and Soul Gold has done a fantastic job of moving into a new country, Ecuador, making an interesting, nice discovery at Alapala. And some of the drill holes they released, basically 1.2 kilometers of 1.16%, another kilometer of 1.1%, 954 at 0.93%. Those are long, good intervals. And what you can see is that chart is how the share price responded. It went from 2.6 pence to 45 pence over that time frame, which is about a year, a little over a year and a half. Their current market cap is about 450 million pounds. They released a resource a couple weeks ago. And what they did is they took a big resource, they combined indicated and inferred for about a little over 1 billion tons grading 0.68% copper equivalent. 0.68% copper equivalent, all right? I just showed you previously that that sort of grade probably doesn't work as a block cave underground. This thing is down about 600 meters to a kilometer depth. Within that, they've defined a rough 120 million ton high grade core at 1.8% copper. All right, so we're going to look at that high grade core now. First, some reality in terms of geology and mineralization. And what this is a section through the deposit, and it shows the rock type. The rock types are identified by colors. We're going to focus on, well, the geology first, but you can see the indicated is in green boxes, and outside of that, the blue is the inferred. So the rocks of those colors and above, green, yellow, and a dark pink, those are pre-mineral rocks, meaning that they existed before the mineralization came in. The next two, red and pink, those are the intrusives that mineralize the rock. That's where the high grade is. Late stage, there was a little bit of juice going on, so the late stage mineralization is outside that and postdates it. And again, you can see the deep pink and the red are kind of the core of this thing, and outboard of that you've got lower grade. And then the post-mineral rocks are barren. So we're going to take a look at this high-grade zone right there and think about what it's going to take to make this an economic underground block cave mine. And I want to point out, this is to do this in reality, an engineering firm spends tens plus millions of dollars to do it. But all we're trying to do, Joe and I, is get a sense of, does this work? Is this something a major mining company is going to buy? Or is this something that is difficult and they're not going to buy? So we're focusing in on that one zone here, and we've changed the color scheme. Now we're looking at grade, the different colors, the different grades. And down in the box on the bottom there, the low-grade stuff, the stuff that you lose money mining, is the yellow and green. Your break-even rock is the orange, and the rock you make money on is the purple and the red. Now you can get a sense of how that lays in there. And that black box right there is the level that they would have to go into, or they propose going into, in order to start mining this thing. So let's assume that that box that I've drawn there takes in the bulk of the high grade with minimal amount of low grade. That's what you want to do to get this thing started and cover the Capex. So what we did was we took a diameter of that, because when you block cave, it's sort of a diameter and it falls in. And there's no cutoff grade when you're dropping everything down into the mine, because you can't differentiate it. Everything that drops into the mine has to come out. So we got a basal diameter about 250, a height of about 250 meters. If we run through and do the math on it, that gives us in the order of 34 million tons within that drops into the high grade. And I'm estimating that's about 1.5% copper equivalent. Does this sort of make sense, what we're doing here? I hope so. So we've defined what the high-grade mine will more or less look like from very, very early stage, evaluation. And that's what we want to do. All right, what happens from here on out? Okay, so it's too deep to strip. It appears to be too low grade to be cut and fill, so we got to look at a block cave underground. What's got to happen from here in the pre-feasibility studies, the future work, is they've got to determine the geometry of the deposit, the grade distribution in more detail, rock mechanics, if there's a lot of faults or shearing in there, it affects what falls into the hole. Metallurgy has not been figured out yet. We don't know if the gold floats with the copper or not. Think about water. This isn't a jungle. If you've got water coming into a big hole, you've got to pump that water out. If you're pumping it uphill, that's a big expense. Shaft access, tunnel, Capex, crushers, conveyance system, mill, concentrate transport, all that has to be figured into what this thing turns out, if this is economic or not. And that takes time, a lot of work, and a lot of money. Which brings us to this slide. This is a really useful thing to keep in your mind at all the time. What we've seen countless times, and you all as well too, there's the initial work, the excitement builds, the discoveries made, it's all blue sky from here, and then it comes down to, what are the limits? What are the economics on this thing from here on out? What's the metallurgy? All those sorts of things come in, and we start doing the more advanced studies, and that's when it drops off, because more often than not, these things are not economic. That's just the way it goes. So our goal at Exploration Insights, Joe and I, is to identify something that looks like it's a real discovery and might be a real deposit, but evaluate it continually with those parameters I showed you what we're doing with the block cave, and if it starts not to work, we leave. Okay, so a few quick notes on the odds. Basically, for every 2.5 gram deposit, the good Lord made 10 1-gram deposits. A 1-gram deposit sitting at surface probably works. A 1-gram deposit sitting at 200 meters depth probably doesn't. So right off the bat, when we're drilling deep and blind, our odds of discovery an economic deposit have got a lot worse. And the question you want to ask is, how much money does it take to disprove a concept? And whatever company you're looking at and speaking to, they need to have that answer. So basically what this means is we need to kill these things as quickly as possible, know the funding requirements of the company, understand what the go, no-go decision points are, economic parameters, geologic parameters, what's the social, environmental situation, is success meaningful? All too often, even if a company is successful, what they end up finding is really not substantial to the share price or the risk you're taking buying these things. And that's what really counts. Does it translate into a real share price increase? All right, so on our website, there's lots of free information. Go there and look at it. If any of you are interested in seeing one of our sample letters, send us a note. We'll be glad to send it. And now I'm going to open this up to questions for Joe and I on any of your favorite or least favorite companies. Anyone? Yes, sir. GT Gold. You've looked at that in a fair bit of detail, and so have I, so I'll do it. They've done a great job there in the Golden Triangle. They got a soil anomaly, some rock samples, the geology is right. They drilled some nice intersections. The share price went way high. But what's happened is when you start looking at the drill holes in detail in the sections, in my view, the mineralization is chopped up. It doesn't seem, I don't know how it's been chopped up, it doesn't seem to be hanging together. So in terms of putting that into production, there's not, as yet that I can see, a continuous vein or structure that you can go into in either open pit or underground mine. Some nice hits, but it's just not hanging together very well, unfortunately. They've done a great job, that's just the breaks. Yes, sir. If I got the question right, you're asking how do you decide when it goes underground versus open pit? Again, it comes down to economics. If you've got a 10-gram deposit with 1 million ounces sitting at 200 meters depth, you could probably open pit that. It would probably be cheaper to underground mine it. So it really comes down to economics. But once you start getting below 200 meters, you're probably looking at some sort of underground operation.
Well, I'd say that you got to look at it from how much does it cost to mine at open pit. If the strip ratio starts blowing out on you and you're like 15 to 20 to 1, that's 20 more tons of dirt you got to move for every ton of ore. And then if you look at the cost, then it's 21 tons of dirt that I have to move for 1 ton of ore. Is it better to go underground? And that transition depends on the grade of the deposit. That sort of thing happens more with vein deposits than disseminated deposits. But they're obviously like porphyry copper deposits that go down a kilometer in an open pit like Bingham. I mean, it's amazing how deep that deposit is, just because it's still economic. So it's relative, but if you get something like a vein deposit and it works like an open pit, it might only work for the first 70 meters, and then the strip ratio gets ridiculous, then they have to go underground. And so back to GT, like I personally think that would be more likely originally an underground. So all the near surface stuff might never be mined because you'd have to leave it in a pillar. So it's really the deep stuff that would matter because just of where it's located. Like if you look at IDM and its location and that's all underground. Nobody's thinking about an open pit there. The other problem is on the valuation side. If you look at GTT's valuation at one point, I think it was 3 to 4 times as IDM. And I thought at that point GT Gold would have killed to have IDM's resource and grade. But they were trading it already at 3 to 4 times as much.
Yes, ma'am. I don't know Ascot well enough, do you? No. I mean, I've seen some great drill holes, but I have not been able to put it conceptually in my mind. Yes, sir.
Equinox.
Equinox.
What is Equinox?
That's that merged company. Yeah, I spoke about that yesterday when Mayor and I went at it. In short, the deposits they've got, I don't think work very well. They're not great. Certainly Arizona, down in Brazil, it's a relatively narrow shear zone. The grade is being carried by relatively few drill holes. It's spiky. I don't think that works well. And Castle Mountain's difficult as well. But that said, they've got a $550 million market cap, and Ross Beatty seems to be making this his new vehicle. So my suspicion is he's going to use this market valuation to go out and acquire something that's actually better. I mean, that's the bet here to me. But I don't expect Arizona to be a very good deposit. Yes, sir.
Early exploration company in Peru, Camino Minerals.
So, like in the letter, we get questions about companies like this that we don't own, and Camino Minerals was one of them back in Q1 when they hit that drill hole at Los Chapitos, I think it's called, near Mina Justa. And so our problems initially with that was it was all RC. The recoveries were, some places were less than 70. I mean, sometimes it was 30% recoveries. And so we didn't know what the grade really was. And also it looked like the way the drill hole was drilled, it just ended up going right down what looked like a breccia pipe. So immediately we thought, well, we'll back off and wait for the diamond hole. And that diamond hole came back and gave you a better idea of what the grade could be. The issue in that part of Peru and that kind of deposit metallurgically, the company that bought Mina Justa spent a lot of money on it. I think it was 500, 600 million, but they've written it all down. And it seems to me if they're not interested in developing that project, I don't see anybody else coming in to get something in that area. So we never bought that one.
Yes, sir.
Do you have any fresh thoughts or insights into Novo Resources in Australia?
I'm going to guess that's for me.
Yeah. That's all you
I went and looked at that over the summer, and I came away really impressed. And I've known Quinton for a long time. Quinton Henning, the president, is one of the best exploration guys I know. So we bought it in the letter, but subsequently we've sold out. We've done pretty well on it, but we've sold out because what I was looking for was a relatively thick horizon conglomerate bed that had some nuggets in it, but there was indications that there was disseminated mineralization in it as well, finer gold. What we've found so far, what they've released so far, is basically it's a very narrow or thin horizon with the gold nuggets and not much above it. And this comes back again to what's it really going to cost to mine that? We could have a zone this big running 30 grams, but if you're strip mining this thing, your dilution is going to be at least 2 to 3 meters. So it gets very difficult. So it's gone from a blue sky story to a show me story. And what they need to show is that they've got more than just that one narrow horizon, and that there's a way they can legitimately get some assays and come up with a resource. So that's where we're at on that one. Yes, sir.
Any thoughts on Kirkland Lake?
You visited it.
I mean, portfolio of assets. We owned Newmarket, and that one did very well for us, that Kirkland ended up buying, which was a good liquidity event for ourselves. We really liked the Fosterville deposit, and that's changed completely. I mean, that changed within Newmarket, and it continues to be a really good asset to have. I mean, we right now we're not into a lot of producers in the gold sector. We're more looking at exploration. So Kirkland's a good company in that. It's got a lot of good assets, diversified. So if you like it, I mean, that's as good a pick as any. We own more Premier Gold because we like the cash costs right now, because we're really not sure what the gold price is going to do. So getting a low margin, a high margin, low cost thing like Premier was our idea at the time. Sorry?
What time's our next meeting?
We got time. If
We got
that
time?
red thing
Okay.
doesn't mean
Another
anything.
question?
Next Gen Energy.
Good deposit, excellent team. The issue, I guess, we still have an issue with uranium, and we've said that. But if you like uranium, exploration would be the way to go. But I think we would favor going into one that's probably a 5 to 10 million market cap that's just starting out, rather than going into one that's where Next Gen or Fission or some of these other guys are. We don't mind uranium, but we're just taking a longer term look at an opportunity rather than buying a producer or a developer at this point.
Yes, ma'am.
Nevada exploration.
Sorry?
Nevada exploration.
Well,
Nevada.
Oh, Nevada exploration?
Nevada.
That's the water chemistry sampling group, right? Am I been cut off? Can you hear me? Okay. It's a good concept. What they're doing is drilling holes, taking water samples, and analyzing them to see if it's gold, hoping that leads them down to a source in the bedrock. It's a nice concept. It's a nice tool, but it's only a tool. It's not something that I would use or put a lot more credence in than geophysics or biogeochemical sampling and that sort of thing. That's my view. Yes, sir.
You have a comment on Canada's zinc?
No, I'm afraid not. Orezone.
Orezone. We talked about that one before when they had the resource, and the resource was wrong. And it's interesting sort of case study in that Tim Oliver, sometimes a contributor to the letter, actually rated the Orezone feasibility study quite highly, and the resource was just wrong. And right now, at this point, we're not, again, into development plays right now, and low-grade hard deposits in West Africa is really not where we're heading.
Okay, I guess we can do a couple more. I know we're over time, but so she said one more. Go ahead.
Silver Bowl Resources.
No.
Okay, a real one. I got to do the microphone because.
Superior Gold.
Which one?
Superior Gold.
Superior. Is that the Sterling deposit?
It's in Australia.
No, I don't know that
No,
one.
sorry. No.
All right, well, we've got to run. Thank you so much. I hope this was useful. Come to our website. We'll be running around here. Thanks.